An industry that went unchecked is finally being told to pay for its years of bad behavior.
It's a scathing assessment of conduct driven by greed and behaviour that was in breach of existing law and fell well below community expectations.
A royal commission into Australia's financial service sector has submitted its full report to the government. Its 9-month inquiry led to admissions by banks, insurers, and pension funds that they routinely lied to customers and regulators. They also took money from the dead. But that wasn't even the worst of it.
And who could forget the appalling audio recording of a young man with Down syndrome being subject to high-pressure sales tactics, resulting in the purchase of a financial product that he clearly did not want, need, or understand.
The Commission recommends the creation of a compensation scheme paid for by the industry for victims of misconduct. It also calls for a new oversight body that would keep a close watch on the banking and corporate regulators. And it seeks the removal of incentives that encouraged the abuses. The report singled out Andrew Thorburn, CEO of National Australia Bank, and the lender's chairman, Ken Henry, for failing to take responsibility for the abuses under their watch. Both have announced their resignations. The chairman leaves at the end of the month, while the CEO will wait for a replacement.
Banks understand that these failures have caused deep hurt, suffering and heartache for far too many customers, and they are sorry for the pain that they have caused. Importantly, banks accept full responsibility for these failings, and they know that they must now change to ensure that this never happens again.
The ruling coalition government had been accused of deliberately delaying the formation of the Royal Commission, saying for more than a year that there was no need for it. Now it's under pressure to pass the recommendations, or face the public's fury in parliamentary elections this May. Paolo Montecillo, TRT World.
Well, Steve Keen is an Australian economist and former professor at Kingston University London, lends us his insights on the story. He thinks there's little stopping banks from going back to business as usual.
If you take a look at what's been happening for the last decade, the Australian economy managed to jump over the global financial crisis fundamentally by restarting its housing bubble, with government funding trebling and in some cases quintupling for first-home buyers to stimulate them back into the economy. And that really basically set off a free-for-all where what was already pretty revolting behaviour by banks just got into overdrive. And they've been lending effectively to anybody with a pulse to keep the housing bubble going, believing they weren't doing anything wrong, ironically enough, until the Royal Commission exposed just how bad their behaviour had been. But I think the fundamental bad behaviour is still untouched, and the Commission's recommendations have not affected the bank's use of what they call the household expenditure model. Now, this model, so-called, has been exposed by the Commission's documents and shows they estimate the cost of raising a child in Australia, wait for it, to be $208 per month. That's about $7 a day. That wouldn't even buy you a hamburger, let alone an education for a child. And yet they use that to assess how much money people have to repay their housing loans. So the fraud is still going on. The same thing happened in America. Remember the global financial crisis, which was disastrous for America, really only resulted in one person being jailed. That was Bernie Madoff, and you couldn't not jail Bernie Madoff. So they managed to fob things off, a couple of public relations events, and the same old behaviour continues on and revives again during the next bubble.